the cause of a country's financial distress will be chronic fiscal mismanagement? Probably. There are certainly cases in which the cause of the distress is a wholly external factor. An earthquake, a hurricane, a tsunami, a pandemic, for which the country is blameless, but nonetheless is now facing a debt crisis. And the reaction of creditors will differ, of course, depending on their perception of the underlying cause. If the creditors perceive the underlying cause to be chronic fiscal mismanagement, then quite understandably, they won't want to give debt relief to the country unless the mismanagement is addressed. And this is very often where the IMF comes into the picture. The IMF will typically prescribe or recommend changes to fiscal policies in order to put the country on a sounder footing. And commercial creditors often, not always, but often, will say we want the debtor country to have the tutelage and monitoring of the IMF so that our debt relief is simply a bridge to a healthier Ruritania down the road.
When bondholders approach a discussion, do they have a yield in mind that they'd like to achieve? From a very practical point of view, so then it's a matter of figuring out which components to adjust by which degree to achieve that final yield.
Yes, to a degree. The bondholders will assess the situation and they will form a kind of collective judgment about what they will call the recovery value. So I hold a piece of paper that says I'm owed $100. The country is in debt distress. That piece of paper is trading in the secondary market for, let's say, $40. The bondholder will go into the debt restructuring and say, I'm prepared to provide debt relief. And hopefully the market will perceive that debt relief, when taken together with the fiscal adjustment that the country is undertaking, often at the insistence of the IMF, and any official sector support that the country is getting, that those elements will improve the country's credit position such that the piece of paper that I get in return for my $100 bond, while it might call for a payment of $70, will nonetheless be valued in the market higher than the $40 that I'm currently holding. And that valuation of the new piece of paper is called a recovery value. It is highly dependent on what the market calls the exit yield, exiting the debt restructuring, the yield meaning what is the discount rate that the market will apply in valuing that. And again, the hope is that a confluence of those three factors will reduce the discount rate over what it is today in the middle of the debt crisis. And will they have a view? Yes, they'll collectively have a view. I don't want to suggest that the bondholder community is a Borg collective, but it is, they will reach a consensus more or less on what that recovery value is. And then the negotiation comes down to whether that recovery value expectation is consistent with what the country feels it needs by way of debt relief. And that's the negotiation.
So we've got an audience that is both global. Some of them seem to know the subject quite deeply. Others are very curious. And among those who are curious are those who want to know about how you deal with holdouts. What are holdouts? in current sets of negotiations around credit restructuring, how common are holdouts, and how do you deal with them?
Yeah, this is a perennial issue in this business. Starting in 1976 in this country, 2 years later in England, creditors of sovereigns for the first time were able to sue those sovereigns in domestic, in US and English courts. And so a debt instrument issued in the last 45 years by a sovereign means that the holder of that instrument is theoretically entitled to decline any debt restructuring offer, and if it is not paid in full and on time, to go and sue on it and to try to extract a preferential recovery at the sharp end of a lawsuit. That's the reality. It wasn't a problem much in the 80s and early 90s because the commercial banks were the universe of creditors, and commercial banks either responded to peer pressure, so other bankers would say to them, "You're breaking ranks with us," and when that failed, they got a phone call from their regulators that said, "We expect you to go along with Ruritania's debt restructuring." But when the banks left in the late 90s and were replaced by bondholders, you're talking about thousands of individual bondholders, every one of which is holding a piece of paper that is legal, valid, binding, and enforceable in a New York or English court. And how do you herd those cats into a debt restructuring, recognizing that by definition the debt restructuring is about to impose a loss on them? It was in response to that the move toward collective action clauses came about. There was, and still is, a competing theory promulgated in 2002 and 3 by the IMF for a while, that what we need is a transnational sovereign bankruptcy code. We don't have this problem in corporate debt workouts. Why? Because insolvency codes say that if a supermajority of similarly situated creditors agree to the restructuring, it binds everyone. And so there was an effort to develop what the IMF called a sovereign debt restructuring mechanism, but it didn't prosper for political reasons. The alternative was the use of collective action clauses, but as I mentioned a moment ago, they have their limitations too. It is possible for determined holdout creditors to stymie the use of a collective action clause. How do you deal with holdout creditors? I'm going to be candid about it. It ultimately comes down to the sovereign saying to the prospective holdout creditor, "Look, if you want to, you can get a judgment. We probably can't stop you. But think carefully, because that judgment will convey to you an emotional satisfaction. It will not convey a financial satisfaction unless and until you can find some asset of the Republic of Ruritania, outside of Ruritania, that you can seize and pay yourself back." And now listen to me. There are very few such assets in the name of the Republic of Ruritania. And what assets we do have, our embassies, consulates, and so forth, are clothed with immunity by your law, by US law, by English law, by international law. So think carefully. You can get your judgment, but then we'll search the world trying to find an asset that you can seize to pay yourself back, and you won't find it. So think carefully before you decide to spend all of your money on legal fees. This could end in 10 years with you having nothing but your regrets and your legal bills. That is the sovereign's ultimate argument. Louis XIV used to emboss on his cannon a Latin phrase which translated as the king's last argument. This is a sovereign's last argument.
There are distress credit buyers who do so in the hope of getting a big payoff. Are these still common, or are the players very much the big hedge funds which are fairly serious about investments?
Most of the creditors understand the reality that if you lend money, you take a risk, and occasionally the risk materializes. Most institutional investors will expect the sovereign to behave maturely and responsibly, not to try to use a debt crisis as a tool for stirring up domestic political popularity. And a sovereign that behaves in that way can expect support from the vast majority of its commercial creditors. There will be some, however, who will approach the process with malice aforethought, who will say, I don't care what the restructuring terms are, I am going to try to pressure the sovereign into a preferential recovery for me. And they will probably have the legal tools to do it, although collective action clauses can be extraordinarily useful in defanging creditors that have that view. Do they still exist? You bet they still exist. And indeed, the long, tortuous Argentine saga, which lasted 15 years between default and final settlement, the holdout creditors who were still standing at the end of that 15 years got a very generous payout, very generous. And there is a concern in the sovereign debt community that the memory of what happened in Argentina may induce holdout creditor behavior in future sovereign debt workouts. We don't have a perfect solution to this problem. And remember, I said earlier, it is a zero-sum game. If a creditor succeeds in extracting a preferential recovery from the sovereign, they're not just injuring the sovereign, they are affecting all of their fellow creditors, because they're depleting the pool of resources that will be used to pay those other creditors. So this is an inter-creditor equity issue as well. Emotions run very high on